As Toby said, we're in a very volatile and unpredictable world, and one where certainly for the last 4 years since the Lehman crisis, the battle between greed and fear has been very much on the side of the pessimists. The issue that all of you have to confront when you're dealing with your clients is probably more than ever before now capital preservation rather than capital growth. And this has been the focus. It's really been survival rather than advance that has been the focus in the minds not only of investors, but of the business community, of politicians, of international leaders, of central bankers. And so what I'm going to talk about mostly today is the risks rather than the opportunities facing the world economy. But in my introduction, what I want to draw to your attention is that taking a longer view, which we all should be doing, although it's becoming virtually impossible to do so with the extreme volatility and the tremendous losses that people have suffered over the last few years, taking a longer view, the opportunities today are greater than the risks and arguably are greater than ever before. And I'm going to spend less time on the opportunities than the risks simply because those are the risks are the issues that we have to address in our day-to-day dealings with the markets and the clients. But all the time, I want you to bear in mind that actually we are still in a world of tremendous opportunities. So I start out with the risks. It's obvious what they are today, and interestingly enough, they're more or less the same as the risks that preoccupied people at this time last year. Europe, China, tremendous growth followed by a slowdown. Is this going to turn into a crash landing, or is China and other emerging markets now settling down into a period of somewhat slower, more sustainable growth? The US, of course, everybody has been wondering, not just for the last few months, but for the last 4 years, whether the US can move out of its deepest recession since the 1930s into a period of sustainable recovery and expansion. And finally, there's the perennial concern about financial bubbles. We've seen financial bubbles burst in technology stocks, in housing and mortgages, in the euro. Is there another bubble that's about to burst? So these are the issues that have been on people's minds actually for the last 4 years. And as I say, they've been very much in focus this summer and, as it happens, last summer. What I'm going to argue to you in most of my talk is actually that the priorities that the market is now focusing on are likely to turn out to be the wrong priorities. Right now, it's perfectly obvious, if you open any newspaper, that Europe is the number one concern in the mind of nearly everybody, not just in the markets in Europe and Britain, but all over the world. When I go to Brazil, to South Africa, to Australia, where my firm has clients all over the place, the only question they ask us about, even the only questions they ask my colleagues from Beijing about, are what's going on in Europe and what effect is Europe going to have on your part of the world, whether it's China, Hong Kong, or South Africa. A year ago, that was absolutely the right question to ask because people did not understand the scope of the European crisis. There was extraordinary complacency about Europe a year ago, which is best indicated, and one really has to pinch oneself to realize this was true. A year ago, there was such confidence that the euro crisis had been solved that the European Central Bank was raising interest rates, not once but twice. And the main question that was being asked by analysts in the City or on Wall Street was how much further, how much more monetary tightening are they going to have to do in order to get inflation and excessive growth in Europe under control. So that was only a year ago. In that environment, I believe that Europe was absolutely the number one concern that people should have had on their minds, because clearly this was a slow-motion train crash that was going on that had not yet been understood. Now, the markets, as we all know, being professionals, are not moved by events. The markets are moved by unexpected events. And the point, well, really the main point that I want to get across in this talk, and incidentally I plan to leave a reasonable amount of time at the end for questions, but the main point I want to get across in this talk is that if we're trying to analyze not just events, but where is the gap between market expectations and events, then the situation in Europe is completely different today from what it was a year ago. A year ago, the situation was terrible, and the markets thought that it had been more or less solved, and even more importantly, the policymakers were very complacent. They thought it had been more or less solved. Today, the situation is still terrible, with very little hope of significant improvement, as I'll explain at the moment. But the expectations are completely different. Everybody recognizes it's terrible. This story has been on the front page of every newspaper literally in the world, as I say, in China and Brazil, for the last 6 months. So in order to generate a market-moving surprise, Europe would have to do something significantly worse or better, and I'll come back to that, significantly different anyway, from all the scenarios that we've been reading about every day in our papers, on the front page and on the comment pages of the FD, the Wall Street Journal, the Herald Tribune, and so on. And that's why I think, actually, and that's what I'm going to argue, actually Europe is going to turn out to be the least important of these issues in terms of setting the trend for financial markets over the next 6, 12, 18 months. I'll come back to each of the others in a minute. But before I do that, as I said in my very brief introduction, I want to remind you that this is not just a world of risks. This is also a world of opportunities. And as we assess the risks in Europe, in China, in America, these are the things that we have to bear in mind. This is what I wrote my book, Capitalism 4.0, largely about. I'm not going to try and publicize it or anything. But let's bear in mind that since 1989, and the reason for choosing 1989 is it was a critical year in world history of an infinitely more important type than 2008 and the Lehman crisis. It was the end of communism and the demolition of the Berlin Wall. Since 1989, there have been these 4 enormously important megatrends, as I call them, really driving the world economy and the world political system. The end of communism, obviously, the rise of Asia. They're partly interconnected but separate. 3 billion new producers and increasingly consumers entering the world economy. The information technology revolution, largely by coincidence, 1989 was actually the year that the internet was invented. It's hard to believe that it's actually only 20 years, but 1989 was when a British physicist called Tim Berners-Lee, working in CERN in Switzerland, wrote a paper on the so-called hypertext transfer protocol, which is the essential concept of the internet, of being able to recognize text that is written anywhere in the world from any computer instantly. And really, that is what made possible not just the enormous advances of information technology, but also the entire concept of economic globalization is built on the collapse, the virtual elimination of information costs and, to a large extent, transport costs, which has turned the whole world into a single economy. And finally, the invention, really the invention of pure paper money. Now, how can I say the invention of paper money? Paper money's been around for thousands of years. But the fact is, it's only in the last 25 years or so that the entire world has been operating on a system of pure paper money. Literally, this is the first time in thousands of years of history, pure paper money that's not linked to gold or silver or diamonds or slaves or cowrie shells or to any other external standard of value like a foreign currency. The world has had paper money since 1945, but all paper money around the world until the early 70s was linked to the US dollar, and the US dollar, in turn, was at least theoretically based on gold. Now, that system broke down in 1971 with the end of the Bretton Woods system. It was followed by a period of tremendous inflation as the world learned to live with paper money, and it was only in the late 1980s that inflation had settled down to the point where a completely new and unprecedented form of paper money was invented, namely the euro, with the Delors report, again in 1989, took the enormous imaginative leap of saying, we can now create a form of paper money that's not even linked to a specific government, that doesn't have a nation behind it. Now, whether that was a good thing or not remains to be seen. But again, this has created a completely new world of a kind that never existed before, in which governments and central banks can print money, can use that money either to create inflation, as they did in the 1970s, or to stabilize the financial system and to try, sometimes unsuccessfully, to moderate financial and economic cycles in a way that was literally never possible until the mid-1980s. So these are four enormously powerful trends that we should not forget about, and at least the first three of them are clearly extremely bullish. Now, paper money and the financial revolution that it created may be less so, in fact, is now clearly going to reverse. But even if the fourth of these is going into reverse, there is no chance of the first three reversing. And in fact, we're only at the beginning of these phenomena, as Toby suggested, and I'm going to come back to. So let us not forget that these are the things that drove the very widespread optimism both in financial markets and in the world economy until 2007. And they were not complete delusions. They were real events. And certainly when the history of the early 21st century is written, perhaps in 2050, 2060, I would suggest that it's very likely that these issues are going to figure much larger than deleveraging or falling house prices or the end of a medium-sized Wall Street investment bank. So let's bear that in mind. Having said that, as we all have to operate day-to-day in the markets, and as I say, the perspective of our clients is not the next 10, 20 years, but the next 1 or 2 years, and survival rather than prosperity. Let's go back. We have to go back to the biggest risks. So the biggest risk, as I said, is believed to be Europe, but almost certainly isn't. One reason for that is that much of this is already discounted. Another is that Europe is actually much less important to the world economy than people realize. Now, the EU still accounts for roughly 20% of global growth. So you might say a recession in the EU or a financial crisis in the EU could have a very, very serious effect on the world economy. But if we look at the EU's contribution to the growth of the world economy, as opposed to the flow, if you like, rather than stock of world economic activity, what we find is that actually for the last 4 years, Europe has been making no contribution whatsoever. In fact, a slightly negative contribution to global economic activity at the margin. And the flow effect over the last 4 years, and even over the last 10 years, it's been much less than 20%. It's been roughly 7% of the incremental world growth. So in itself, Europe is not as important as people believe unless it generates a financial crash, a banking meltdown of the kind we saw in 2008, a European version of Lehman. And that's an issue that I'm going to come back to when I discuss Europe in a little more detail. But just to preview my conclusions, one thing that seems very clear from the behavior of European policymakers, and particularly the ECB, is that preventing another Lehman is the one thing that they are both able and willing to do. And that's because preventing another Lehman is an issue which can be handled by the ECB alone. It does not need the degree of policy coordination, of political consensus that's required to stabilize the euro as a long-term entity. Preventing another Lehman means a central bank willing to lend without limit to an institution that's potentially insolvent and doesn't have any decent collateral. This is something that central bankers are taught from their earliest days that they must never do. This is what the Fed refused to do in the case of Lehman. They wouldn't lend to Lehman because it was insolvent and didn't have any collateral. This is what the Bank of England refused to do to Northern Rock. This is what the ECB has consistently been doing for the last 4 years. It's been lending without limit to clearly insolvent institutions like Greek and Spanish banks that don't have any decent collateral. And in that sense, the ECB has actually been much more proactive, much more dynamic and aggressive in supporting the European banking system than either the Fed or the Bank of England has been in supporting the US and UK. And therefore, the chances of a purely financial meltdown in Europe that would bring down the rest of the world economy in the same way as Lehman did in 2008, I would say, are actually very low. What we need to focus on analyzing Europe is how much of a drag is it going to be on the world economy, even if it doesn't generate a cataclysmic financial crisis. And in that context, the story in Europe is probably not as bad as is widely believed. That's about the only sense in which it's not as bad, and I'll come back to other senses in which it's probably worse than widely believed. So Europe is probably not as important as people believe. The other issues that I think are probably not as important as people believe are the potential crash in China and the bursting of financial bubbles. The potential crash in China, I'll be very brief about this because I've been asked to talk to you primarily about what's going on in Europe, Britain, and the US. The potential crash in China is essentially a fantasy that has been blown up, has been invented by a number of by a lot of very clever and successful financiers who made tremendous profits out of the subprime crisis in the US. A number of them also did very well out of the European crisis over the last 4 years. In fact, a number of them closely related to my firm, which was one of the first that set up a hedge fund directly oriented towards European divergence. It was called the European Divergence Fund. It was wound up about 6 months ago. And now they're looking for the third great financial crash, for another opportunity similar to subprime and European financial sovereign credit divergence. And they've identified, they think, in China. They think that China is the next great financial bubble. They are clearly wrong. Anybody who is speculating against the credit of the Chinese banking system and speculating on the idea that China is going to suffer a vicious circle of falling property prices, declining bank credit, collapsing banks, and therefore a collapsing economy, is speculating not against the Chinese banking system, but against the Chinese finance ministry. What people, primarily in the US, but in Europe, don't understand is that the Chinese banking system is not a private banking system in the way that the US and Europe is. It is part of the Chinese Ministry of Finance. When Chinese banks make loans and when they have to write them off, they're essentially not making credits which they then lose money on. They're making grants from the Chinese government. And that's how it's conceived. The people who run Chinese banks are appointees of the Chinese Communist Party, the top management, and they circulate back into the top levels of the Central Committee. So the Chinese banks are part of the Chinese government, part of the Chinese treasury. If you're speculating against the Chinese treasury, you had better have more than $3.5 trillion, which are the Chinese treasury's foreign exchange reserves. And that is the key difference between, in terms of finance, in terms of the Chinese financial bubble and the bubbles that we've seen in the US and Europe, and therefore it is not a bubble that is blowing up. It is an economy that is going through a transition from very rapid growth to slightly less rapid growth with a different structure, and I'll come back to it in a little bit more detail, but it's not an economy that is subject to a crash landing in the same way that we've seen in the US and Europe. So I think we can set that aside at least as a major market-moving event for the next 12 to 18 months. And the fourth issue that, of course, people have had in mind was bursting of financial bubbles. So we've seen all these other bubbles. Is there another bubble about to burst after the housing, the euro, and so on and so forth? Now, this, I think, is a concern, but actually a rather different concern from what people have had in mind for the last few months. After the very decent rally that we saw in most stock markets, well, in all stock markets around the world, starting last autumn, last October, there was a view, at least until 2 or 3 months ago, that the stock markets had got very overheated, are riding for a fall, overvaluations, and that there was a potential for another stock market crash, perhaps comparable to the one that happened in 2008. In my view, this was a big misunderstanding of the situation. The real bubble, if there is a financial bubble building up, is not in equities, it's in bonds. And it's above all in the best quality, so-called safest government bonds, US Treasuries, German bonds, and British gilts. And I illustrate this in this slide, which shows, at the top, it shows It shows the S&P 500, the change over periods of 5 months, which is basically from the period from the beginning of October till the end of April, when till the end of March, beginning of April, when the stock markets all over the world were going up in more or less a straight line. S&P 500 had gained roughly 20% in that period. And what I've done here is look at all the periods when the stock market has been that overbought, 20% gains over 5 months period. And what you can see is that there have been many, many such periods, and in most cases they actually haven't been followed by declines year on year or 5 months on 5 months. They've just been followed by a slowdown in the rate of ascent. What I did here was look at periods where the U.S. Treasury bond, the long end of the U.S. Treasury bond market, had gone up by 20% or more over a 1-year period. Now, of course, Treasury bonds, even the long end, are less volatile assets than stock markets. So you take a year-long period rather than a 5 months period. How many times have we had a bull market in bonds as great as the one that occurred in 12 months to last May? And what you see is that over the last 23 years, there's only been one such period before, and that was in 1995, after what was actually the biggest a rebound really from the biggest bear market in bonds in history in 1994. Other than that, this is totally unprecedented. Even if we draw the line at 15% and look at periods when the bond markets have been 15% overbought, if you like, on a year-on-year basis, every single one of them has been followed by a significant decline, by the line falling below the 0 point. So history at least suggests that if you're looking for a bubble anywhere in the world, it's in the bond markets rather than the equity markets that you should be looking for that bubble or focusing your concerns. And I'll come back to that briefly right at the end. But the reason I emphasize this is that taking a longer-term view of our job of asset allocation, I think we're now in a very critical, potentially dangerous, but also potentially attractive position. We're in a world where there has been an enormous asset reallocation away from real economy assets, from property, from equities, to fixed income bonds, both in the private client portfolios and even more so in the institutional portfolios and pension funds, sovereign wealth funds, and so on and so forth. This has now been going on secularly for about 20 years, but in a very, very extreme way since the Lehman crisis. And yet, at the end of this period, there is a greater conviction than ever that the safe asset is the bond market, particularly the US Treasury, the German, and the British gilt market, and the dangerous asset is equities. This is a typical psychological situation that you see at the end of a long-term bubble of some kind, and at a point when asset allocation, it's always at the most difficult points that asset allocation, that you have to go against your instincts and against the instincts of your clients in order to make a constructive long-term decision. And I think potentially we are at that kind of point. Because what the markets are discounting, certainly what the bond market is discounting, is a new normal in which even 2% bond yields, even 1.6% bond yields are attractive because the risks for the world economy are so clearly tilted to the downside that you are much more likely to preserve capital by holding bonds at 1.6% than you are by having real value assets that will generate growth if the economy surprises on the upside rather than downside. And the interesting thing is that, that's one conviction that everybody, whether they're an investor or an economist or a policymaker, would agree with, that the risks of the world economy are clearly on the downside. And the interesting thing is that there is actually no evidence for this. Now, you might say, how can I possibly say that? It's clear that the world economy, at least for the last 4 years, has been extremely weak. But that is actually not true. And this relates to the point that Toby was making. If you look at the growth that has actually happened, I'm not even talking of forecasts, the growth that has actually happened in the world economy in the last 3 years, 2010, 2011, and the first half of 2012, what you find, and these figures come from the last IMF World Economic Outlook, what you find is in the last 3 years, the world economy has been growing at or actually slightly above its long-term average trend over the last 30 years. 2009 was clearly a completely exceptional year, the worst fall on record. 2010 was much stronger, more than one standard deviation above the long-term average. 2011 also well above the long-term average. 2012 forecast slightly below, with a rebound back to above the long-term average in 2013. Now, you might say, how can that possibly, as I say, these figures come straight from the IMF, but how could this possibly be true? Because we know the Europe is in recession. We know Britain's in recession. We know the US, while it's recovering, is experiencing a much slower recovery than after any previous economic downturn. So how can the world economy be at or slightly above the average? And this relates to the point that Toby was making. The reason for these figures is that the US and Europe are no longer the dominant part of the global economy. In fact, I would go slightly further than the figures that Toby mentioned at the beginning. Relates back to what I was saying about Europe. In terms of the stock of global economic activity, Europe, the US, the other OECD countries are still about 60%, and China and other emerging markets are still only about 40%. But in terms of the flow of economic activity, we are already in a world where the flow is coming 70 to 80% from emerging markets and only 20% from Europe. And from Europe and the US. And what that means is that even while the OECD countries continue to be much weaker than they have been over the last 30 years, the world economy as a whole is right on its long-term average growth rate. Now, does this mean you should only be investing in emerging markets? Not at all, and we might discuss that a little bit in the questions. But it does mean that businesses that are exposed to the global economy as a whole and well diversified across that global economy have at least as many opportunities today and will continue to have in the years ahead as they have had at any time since 1980. So the new normal, even if it's different in the US, Europe, and Britain, is not as different from the old one as you might believe. And that in turn means that very low interest rates, negative real interest rates around the world, which have spread from US and Europe to the whole rest of the world, are actually now an incredibly stimulative factor, a much more stimulative factor than people realize, because not only are real interest rates minus 2 or 3% in the US and Europe, or minus 1 or 2% in the US, Europe, and Britain, but they're minus 5 or 6% in China, in Brazil, in Latin America, and in the rest of Asia. So we're in a world environment with incredibly stimulative monetary policy, incredibly stimulative fiscal policy, growth already at the average. So tell me, are the risks in the long term on the upside or the downside in that environment? At the very least, I think you would have to keep an open mind on that question, which is what the markets are not doing. Now, in addition to the stimulative state of interest rates, there are a number of other things that have actually made the risks of a severe economic slowdown considerably lower today than they were a year ago when the markets were preoccupied with these same issues. The most important, probably, is what's happened to the oil price. If there was a real threat to the world economy a year ago, it came either from Europe, as I've already mentioned, or from the Arab Spring, $150 oil prices, and potentially $150 on the way to $200, $250 if Saudi Arabia, Kuwait, and so on blew up. There was no predicting. There was nobody who could have given you a reliable prediction at this time last summer whether the next step in oil prices would be to $200 or back to $100 or $80, which is where we are today. Today, the situation is very different. The oil price is stabilized. And what this chart is supposed to illustrate is that I think we can now have reasonable confidence that oil prices and other commodity prices have begun to stabilize not just in a short-term fashion, but probably for an extended period looking ahead. What this illustrates is that oil prices, going right back on the basis of BP statistics to 1880, have moved in a number of sharp steps followed by long plateaus with a slight downward slope. Of course, this is just history. History does not need to repeat itself, but there's an analysis behind this, which I think is credible theoretically and which we can see unfolding, more importantly, before our eyes over the last year or two. What happens with oil and other commodities is that when prices shoot up in the short term, both supply and demand are very slow to respond. The price elasticity is very low in the short term. Demand doesn't respond because people still have to drive their cars. There aren't any clear substitutes. Supply doesn't respond because you don't find new oil or new sources of oil. You don't even build new oil wells in a matter of months. This is a process of years, if not decades. So in the short term, the responsiveness to price is very low, and the price just continues to shoot up. In the long term, though, the price elasticity of both demand and supply is actually very high. It is very possible, if not pleasant, for the world to change its behavior to become more efficient in the consumption of oil and all kinds of other commodities. In the long run, there are many, many substitutes, as we're seeing with solar power, with nuclear, and so on and so forth. And in the long term, there are new sources of supply that emerge once the price gets high enough, which, of course, we're now seeing with the shale gas and unconventional oil phenomenon. So it's beginning to look more and more convincing that we're on another one of these plateaus. If that's the case, that also creates a much better environment for the world economy than we thought, than we had any reason to believe in a year ago, and than is widely understood today. So what that leads us to is that we're in a world where actually the underlying fundamentals are improving more or less wherever we look at oil, or at least stabilizing at oil, at China. The Eurozone is largely discounted, and really there's one element of severe uncertainty about the world economy, which I'll briefly talk about and then I'll stop. Of these four, it's the US. I would argue, and I've been arguing this very strongly since last summer, that what is going to drive the markets in terms of creating the trend as opposed to volatility in the markets of these four issues is actually the US. It's not going to be Europe because it's largely discounted. It's not going to be China because it's not going to generate any surprises. The US is the one part of the world economy that is capable of generating a big surprise either on the upside or on the downside, given what we know from the figures today and given where market expectations are. And certainly that view last summer turned out to be absolutely correct. Because while in the summer there was this idea, as I say, that, is it China, is it US, is it Europe, is it oil? What actually happened in the markets was very clear. In the first week of October, American economic figures were published, which indicated very strongly that the slowdown in the US economy in the summer, partly driven by the alarm over the debt ceiling limit and so on and so forth, was a temporary event rather than a permanent stagnation. There was a view last summer for which there was a fair amount of evidence that the US was slumping back into a double-dip recession, as Europe has and as Britain had. If that had happened, that would have been an extremely bearish development for every risk asset all over the world. And for 3 months, it looked as if that might happen. In October, there was a strong ISM report and a strong monthly payroll figure, and the clouds began to lift in the US. At the very same time, there was some apparently good news from Europe in the first week of October. Sarkozy and Merkel shook hands. The term Merkozy was invented for the first time, and there was this belief that maybe they've solved the European problem. So the market suddenly became bullish in the first week of October after 3 months of very sharp declines. And it wasn't clear at first whether the improvement in market sentiment was driven by events in Europe or by events in the US. I believed that, as I say, the US was going to be the driving force for the trend in the US. By November, December, it became very clear because the news from Europe kept getting worse. The Merkozy duo had not solved anything. Meanwhile, the news from the US kept getting consistently better. And what we saw was this complete divergence between what people believed was a risk-on, risk-off trade. The S&P 500 continued to go up. The euro continued to go down. But the interesting thing about this euro risk-on, risk-off correlation is that on a day-to-day basis, the euro stock market correlation continued to hold. And this is the view that many analysts still have in their minds. And certainly if you look at the FT or look at Reuters or Bloomberg in their daily market reports, there are two assumptions. One is that the world is driven largely by events in Europe, and secondly, that this risk-on, risk-off correlation continues to hold. When the euro goes up, the stock markets go up. When the euro goes down, the stock markets go down. That is true on a day-to-day basis, but it's completely untrue if you take a longer view. And how can that be? Well, on a risk-on day, the euro goes up by 0.5%, the stock markets go up by 1%. On a risk-off day, the euro goes down by 1%, the stock markets go down by 0.5%. So over a period of time, these two classes completely diverge. And this is, as I say, what we've seen very, very clearly over the last 6 months. And taking a slightly longer view, I think it's even more striking. Since since the Lehman crisis, which is there has been on a day-to-day basis this perfect risk-on, risk-off correlation. As I say, they've always moved in the same direction. Yet, compare where the euro is today with where it was in March 2009, exactly the same. Now look where the S&P 500 is. It's doubled in the same period. So over a longer period, there is no correlation whatsoever between the euro and risk assets. And this really leads me to my last point. This is my conclusion, and then I'll round off and take time for some questions. That it's really the course of the US economy that is setting the trend, while Europe and to some extent China create a lot of noise around that trend. And when we look at the US economy, the situation now, I think, in terms of the figures, allows us to be much more confident than we could have been a year ago, that the negative figures of the last few months have been a temporary blip rather than a permanent slowdown. The last 3 months, US economy has produced very disappointing figures, which is why we've had a significant correction in stock markets and also, of course, in the euro on this short-term risk-on, risk-off correlation. But my view is that in the next 6 months, the US economy is much more likely to surprise on the upside than on the downside. And really there are two broad reasons for this I won't go into in detail. One is that if you look at what's happening in the real economic figures, you find that the weakness of the US economy is essentially confined to two sectors, government and construction. If you look at the US economy excluding those, the grey line there, it's already growing 4.5% year on year. Government will remain weak in the US. Public spending is continuing to be cut. But the construction sector, which has actually been responsible for most of the disappointment in US growth, is now stabilizing. That's the good news, if you like. Now, the bad news, which also turns out to be good, is that even if you don't believe the current rather encouraging figures on US house building and so on, it doesn't really matter because the construction sector in the US has shrunk so much already. It's gone from 6.5% to 2% of GDP that it literally can't continue to fall at anything like the same rate. So the construction sector, the housing, and the whole mortgage bubble can't do the same damage to the US economy in the next 2 years that it's done in the past. So that's the real economy side. The second, and even less widely recognized phenomenon, is that financial conditions in the US are now normalizing. And this is a big contrast to Britain and Europe. The red line here shows money supply growth in the US. And what you can see is that it's now growing year on year by about 10%. This is a rate of growth that has only been seen before over the last 30 years in periods of boom rather than bust. Either real economic activity booms or inflation booms. This is not consistent with a dramatic fall in economic activity or a slowdown in inflation. So, of course, we can't be sure. Economists can never be sure about what lies ahead. But the probabilities now are much more favorably skewed towards an upside surprise from the US in the next few months than they were a year ago. And if you look at what happened to the markets from October last year, when the US did begin to surprise on the upside, you have to conclude that this is potentially a very bullish pivot point for equity markets, and a very dangerous point for bonds. And this really leads me to my last, I'll skip a lot of slides here, to my investment conclusions. Currencies, bonds, equities. Currencies. The most risky asset in the world today is probably the euro, for the obvious reasons that of what's going on in the Eurozone. The potential for solutions to the Eurozone within the next year or so is very, very low for permanent solutions. I say much of the news is discounted, but for a permanent solution is very low because we're talking about political issues which take, even if everybody agreed at next week's summit, would take 1 or 2 years to implement. In addition to that, the euro is a very cheap, the dollar against the euro is a very cheap asset, in contrast to the German bonds, which are very expensive assets. So more and more, I think, of the hedging against the euro crisis is going to occur through the currency markets rather than through the bond markets. The second point I'd like to make, though, is that sterling is not a suitable asset, is not a suitable hedge against our breakdown in the euro. And that's because a very interesting pattern that is shown here, which is that against the dollar, sterling and the euro always move in the same direction. So if you think that the euro is going to fall against the dollar, you can be almost 100% sure that sterling will also fall against the dollar, and therefore sterling is a less efficient hedge than the dollar against a crisis in the Eurozone. In addition to that, of course, we all know about the problem in the British economy, which is that it's been driven entirely by government, finance, and construction. And unlike in the US, the construction sector is not showing any improvement, but much more importantly, government and finance is still going through a long period of contraction. The last point I want to make is just returning to the risk in the bond markets. What this chart indicates is that even if we believe, which I do, that central banks are not going to start raising policy rates anywhere in the world for at least the next 2 years, so if we assume that Fed funds will remain at zero at least until the middle of 2014, it would still be not just perfectly possible but normal for this yield curve to steepen from where we are today by about 150 or 200 basis points, if the world merely returned to an assumption of normal, more or less normal economic activity. So bond yields could easily go up by 150, 200 basis points without central banks doing anything at all. And that really and that's a risk of capital loss of 10, 12, 15% in bond markets where investors are expecting to keep their money completely secure. Real yields are now negative, deeply negative all over the world for the next 10, 15 years. People in the inflation-linked bond markets are locking in guaranteed losses for themselves for 10 or 15 or 20 years in the case of US Treasuries ahead. So panicked are they about the potential downside risks to the world economy. And this is my last slide, what this slide shows is that this is very, very dangerous situation for the bond markets, but it's not necessarily bad news for equities. Now, a lot of people might say, if I'm predicting, which I am, a bear market in bonds, how can I possibly be reasonably positive about equities? Well, the fact is that historical experience again shows, going right back to 1980, over the last 30 years, that severe bear markets in bonds, all these shaded areas, these are times when investors in the US Treasury markets have lost 15% or more of their capital in a one-year period. Severe bear markets in bonds, not a single one of them has been associated with a severe bear market in equities. In half the cases, equities ended up roughly the same as they started, and in half the cases, most recently actually in 2009, equities gained up to 15 or 20%. So the fact that one is nervous about bonds should not make one nervous about equities. On the contrary, I think it should suggest that this is a point for major strategic asset allocations, which of course go against the instincts and perhaps even the instructions that many of us are getting from our clients. But unfortunately, that's the difficult business that we're in. I think I'll stop there. I've got maybe 5 minutes. I'm afraid I've gone on a little longer than I planned, but 5 minutes or so for questions, and then I'll hover around if people have any other points. Yes?
Thank you. Yes, not only go against the instructions of our clients, but much more to the point of our regulators.
That's a very, very good point. Well, certainly one of the reasons for what I think is a bubble in bond markets all over the world is what's happening in regulation, obviously, in the pension sector, also in banks. This is often described as financial repression. Regulators are forcing financial institutions to hold more and more bonds, which by any objective standards are now probably the most risky asset class out there, partly because they have a misconceived idea of what safety is, but also partly because this is a tremendous help in funding large government debt burdens. And unfortunately, this is part of the solution to the long-term government debt crisis, to force more and more investors into negative real return assets in fixed income. To the extent that you're forced by regulators to do that, you have no choice. But to the extent that you have a free part of your portfolio that is not determined by regulations, this is a great opportunity to arbitrage and take advantage, to be on the other side of what is going to be a loss-making trade, in my view, not just for the next year or two, but for the next 5-10 years.
To what extent is the fiscal cliff in the U.S. a threat to growth in that area, given that you're quite positive on the U.S.?
I think another very relevant question. I would say that when I go to the U.S. and talk to people, the fiscal cliff is... just for those who aren't completely familiar with that terminology, it's the sort of bizarre legislative situation that's going to arise at the end of this year, literally on the 31st of December this year, when a whole lot of tax exemptions and tax cuts expire, and in theory, taxes will go up by about the equivalent of roughly $300 to $400 billion annualized, and at the same time, a number of supposedly automatic spending cuts kick in on January the 1st as part of the agreement that was reached last summer to raise the debt limit. So if all these things happen as they are currently legislated, the U.S. would suffer a fiscal tightening of roughly 5% of GDP. Absolutely enormous, guarantees recession. So first point is, if it happens, it guarantees a recession. Is this a big worry? It's certainly probably the number one question that I hear from American investors now, even beginning to overtake Europe, because people are beginning to get a bit bored, frankly, as I've suggested, with the Euro story. The answer is, I think, this is my answer, but I would say this is almost so clear that it's almost the answer. The answer is, first, if the fiscal cliff actually kicks in, the US will go into recession and the whole world economy will as well, and we'll be looking at an economic disaster which will justify bond yields at present levels, et cetera, et cetera. The second point is that for that very reason, there is no way that the fiscal cliff actually will occur. And if you go through all the scenarios, and I'm not going to go through them in detail, of what could happen after the election on November the 6th, what you conclude is that in every single one of them, by far the most likely outcome is that they will simply do, again, what they have done consistently over the last 8 years, so therefore why should we assume it's going to be different, which is just push the problem ahead by another 3 or 6 months, kick the can down the road. For the very reason that they recognize that allowing this legislation to go through would be catastrophic. If there's a new Congress, a new administration, the last thing they're going to want to do, the party that wins is going to want to do, is sabotage their own economic recovery. The party that loses will not have the democratic mandate, having just lost, to sabotage the entire country, to literally blow up the country, almost literally, having just lost the election. So they will have the best possible pretext for pushing these decisions at least 3, probably 6, 9 months forward. And the real issue, I think, about the US is not whether the fiscal cliff occurs in January, which it won't. It's how they will deal over 2013 with what will have to be a very basic restructuring of their tax system and their public spending system. Now, that's a much bigger issue, and I think it will have major impact from 2014 onwards. But that really depends on the outcome of the election, which could be a whole another discussion, and where we would just be speculating. But I think in terms of trying to have a clear vision of what could happen between now and January, we can ignore the fiscal cliff as something that will happen. Having said that, it will continue to influence expectations. So the fiscal cliff is much more of a threat in its potential than it is in its reality. It's time for one more? Okay, one more. And that.
In your presentation, you said that the data out of the US over the last 3 months has surprised on the downside.
Yeah.
And you also expect the data over the next 3 months surprise on the upside.
Uh-huh.
So is it a mistake if the Fed announces further QE tonight then?
Personally, I think it would be. But of course, for that very reason, and also because I think announcing QE would actually be a confirmation that they believe the US economy is in a powerless state and that it is much more threatened with a kind of long-term Japanese-style deflation than there is potential for a more or less normal expansion. That, in turn, I think, influences business expectations, financial expectations. So personally, I think the most bullish outcome would be if the Fed said today, we are ready to do more when required, but we are actually pretty confident that what's happened over the last 3 months is a temporary statistical aberration, and therefore we're willing to wait to see the natural recovery in the US economy germinate. But having said that, I think clearly, and because they now also have the excuse of the euro crisis, I think clearly the chances of a further monetary announcement of some kind are much greater now than they seemed a month ago. But the last thing I'll say is that looking back over the last year, it's not at all clear that it has much influence one way or the other. I think I'd better stop then. Thank you very much.